Now, we talked about interest rate risk as being the risk that interest rates in the financial markets go up, causing a bond's value to decline. If interest rates go up, we'll discount the bond's cash flows at a higher rate, causing the present value of those cash flows to go down. So when interest rates go up, the bond's value will decline. So what determines whether a bond has a lot of interest rate risk or a small amount of interest rate risk? Well, the primary determinant of the amount of interest rate risk that a bond has is its maturity, or the length of the bond's life. We're going to find out here through this example that the longer the maturity, the more interest rate risk the bond has, everything else equal. Okay? So let's look at what happens to bond X when its yield to maturity goes from 6%, increases by 1 percentage point up to 7%. Initially, the bond has a 6% yield that is exactly equal to its 6% coupon rate, so it's going to be selling for its par value initially. And then we'll raise the discount rate up to 7% and see what happens to the bond. So it's a 10-year bond, initially discounted at 6% per year. It pays $60 annual coupon payments and $1,000 par value at maturity, so it's sold for its par value. When we discount those cash flows at 7%, then the bond's price falls down to $929.76. So the bond price has fallen from $1,000 to $929.76. It's gone down by a little more than $70 on a $1,000 starting price. So the bond has lost about 7.024% of its value. By declining a little more than $70, it's lost about 7% of its $1,000 price. Now, bond Y is identical to bond X, except that it has a maturity of only 5 years. It has the same 6% annual coupon rate and is priced at 6%, and then that yield increases to 7%. So initially, this bond sells for its $1,000 par value when the yield is equal to the 6% coupon rate. On this 5-year bond, if the yield goes from 6 to 7%, its price falls to $959. It did not fall that far. It fell $41 in value, so it lost 4.1% of its value when the yield moved from 6 up to 7%. Now, compare that to the 10-year bond X that lost a little over 7% of its value. 5-year bond Y only lost 4% of its value. The reason is because the maturity of bond X was longer. So when the rate went from 6% up to 7%, bond X had cash flows received farther into the future, and they are subject to this higher 7% discount rate for a longer period of time. So when you discount at a higher rate, the present value will go down. When you discount for more periods at the higher rate, the bond's value will go down even more. So the longer the maturity, the greater the amount of interest rate risk that a bond has. So our 10-year bond X had more interest rate risk than our 5-year bond Y. So the longer maturity causes those more distant cash flows to be more adversely affected by the increase in the discount rate. So longer maturity bonds have greater interest rate risk than shorter maturity bonds, everything else equal. If you think interest rates are going to go up in the future, you probably don't want to hold really long maturity bonds because they would lose a lot of value if the interest rates go up. Now again, the reason why the longer maturity bond suffers the greater percentage decline is because bond X, the 10-year bond, has more distant cash flows, more cash flows 6, 7, 8, 9, 10 years from now than does the shorter bond Y. So those more distant cash flows are more adversely affected when the yield is increased. So the longer maturity bond has more interest rate risk than an otherwise identical shorter maturity bond. Now recall that interest rate risk was, with the interest rates going up, the bond's value will decline because we discount the cash flows at the higher rate. And reinvestment risk is that opposing force, that when the interest rates fall, we reinvest our coupons at a lower rate, but that decline in interest rates would have caused the bond's value to go up, which is interest rate risk in the opposite direction. So these opposing forces here are because they're related to changes in interest rates in the opposite direction. So the opposing forces of interest rate risk being bond prices inversely related to the discount rate, reinvestment risk being the coupons reinvested at the changed interest rate, would happen to be favorable when rates go up and unfavorable when rates go down, just the opposite of interest rate risk. One popular investment that is very much a tax-based investment strategy are municipal bonds, or munis. Municipal bonds are bonds issued by state and local governments, and they're typically free of federal taxes. If not, they've probably done something wrong. So a major advantage of municipal bonds is that they are federal tax-free, and they're often free of state income taxes as well. The basic rule is that if an investor buys a municipal bond from an issuer in their state of residence, then they will not be taxed at the state level either. If you buy municipal bonds issued in a different state, then you're probably going to be taxed on the income that you get from those municipal bonds at the state level, but they'll still be free of federal taxes. Of course, investors want to compare their after-tax yield. And since municipal bonds are tax-free, and that's our assumption, since municipal bonds are tax-free, the investors get to keep their entire return on municipal bonds. If corporate bonds are taxable, then they don't get to keep the entire yield on their taxable corporate bonds. So we're going to calculate what's called a pre-tax equivalent. Pre-tax equivalent yield, meaning what yield, if it were taxable, what yield would the municipal bond really be providing us with? To what taxable corporate rate should I compare the municipal bond that is tax-free? Because obviously if I get to keep all my return from a municipal bond, then there would be some higher taxable corporate rate that would be taxed and then be worth that same municipal rate, which is not taxed. So the question here is, what pre-tax or taxable corporate yield would be equivalent to the muni's tax-free yield? The after-tax yield on a taxable corporate bond would be the rate that corporate bond provides placed on an after-tax basis by multiplying by 1 minus the tax rate. TC being the tax rate applied to the corporate bond. So the taxable corporate rate would be multiplied by 1 minus the tax rate to give us the after-tax yield. Well, a muni yield is tax-free, so the investor keeps the entire return. And we're trying to figure out what taxable corporate yield would have to be provided when placed on an after-tax basis would be the same as the muni yield, of which the investor gets to keep the entire yield because it's tax-free. So this pre-tax equivalent, or this taxable corporate equivalent yield, would be solved for just by dividing both sides by 1 minus the tax rate. So the pre-tax equivalent yield would be whatever yield the muni provides divided by 1 minus the tax rate. Because when you would move that over and put this on an after-tax basis, it would be equivalent to the muni yield, of which the investor keeps all of it. So, for example, there's a 5% yield tax-free on a municipal bond. The investor's in the 35% tax bracket, so the investor keeps 65% of whatever taxable corporate bond yield they might receive. So they get a 5% muni yield and they keep it all. So we divide that by 1 minus the tax rate they would pay on taxable bonds. So 0.05 divided by the 0.65 after-tax calculation in the denominator there would give us 7.69%. That is the taxable rate that a corporate bond would have to provide, of which the investor would keep 65%, to be exactly equal to the 5% tax-free municipal bond yield. So 1 minus the tax rate is 65%. Multiply that by the taxable corporate yield of 7.69, and that would equal the 5% that the muni is providing. In other words, a 5% muni is as good as a 7.69% taxable corporate bond if the investor's in the 35% tax bracket. Well, not everybody's tax rate is the same, so let's say that a corporate bond provides a 7% return and the muni provides the 5% return. At what tax rate would an investor be indifferent between the two? So in other words, 1 minus what tax rate could we multiply by the 7% taxable corporate bond to have that exactly equal the 5% municipal bond? So I set the after-tax corporate yield here equal to the 5% muni yield and solve for the tax rate. So divide both sides by the 7% corporate bond yield. So 1 minus the tax rate is 0.05 over 0.07. I can add the 1 to both sides, subtract the 1 from both sides, and minus the tax rate is minus 0.2857, so the tax rate is 28.57%. So if an investor has exactly that tax rate, then the corporate bond will provide 5% after taxes, and the muni already provides 5% both before and after taxes, so they'd be equivalent. For investors with a tax rate above this indifferent rate, for those above that rate, they would prefer the muni because they would lose even more of the taxable corporate rate. For those with lower tax rates, they would prefer the corporate bond because it provides that higher 7% return, and they would get to keep more of that if their tax rate is below this break-even tax rate. They would actually be better to buy the corporate bond and be taxed at their low tax rate because that would give them more than the 5% muni would after taxes. So think about, based on that discussion, who are the primary investors in municipal bonds? Below that break-even tax rate, we said they would probably buy the taxable corporate. Above that break-even tax rate, they preferred the muni. So the primary investors in muni bonds are those high tax rate individuals because they're avoiding more taxes by buying the tax-free muni bond. Now, one more type of bond we haven't studied yet are zero coupon bonds. And it's just like it sounds. They don't pay any coupon. They make no coupon payments at all. The only thing they offer is the par value at maturity. Thus, if anybody is going to be enticed to buy a zero coupon bond, they're going to have to buy it at a price that is much lower than the par value, because their only chance to get a return is to buy the bond at a discount, have it mature for the par value, and their return comes in the form of that gain, that they bought it at a discount and then it's worth $1,000 at maturity, and that discount is what gives them their return on that bond. So for example, ABC issues a $1,000 face value bond. It pays no coupons. It's supposed to yield 6%, and it will pay you the $1,000 face value 5 years from now. Let's discount this on a semi-annual basis. Even though it pays no coupons at all, since so many bonds are semi-annual bonds, we even discount zero coupon bonds on a semi-annual basis. So to price this bond, we'll discount the $1,000 face value 5 years at the 6% yield, but discount on a semi-annual basis. So we're talking about 10 semi-annual periods, 3% per semi-annual period. So the $1,000 face value will be discounted 10 semi-annual periods at 3% per semi-annual period. There is no payment involved. We'll compute certainly a price below the par value. the minus sign meaning that we would pay out $744.09 in order to get back $1,000 at maturity. This bond is selling at a discount of $256 below its $1,000 par value. That $256 has to provide you all of your return over the 5-year or the 10 semi-annual period investment. So the appreciation from $744 up to $1,000 is what gives you your return over the 5-year investment. And that will give you 6% APR return over the 5 years. Now let's kind of recap the basic bond relationships. First, we priced a bond under 3 different yields, and we saw that the price was inversely related to changes in the yield or changes in the required rate of return. Second, we saw that bonds will sell at a discount if investors require a rate of return that is above the coupon rate. The flip side of that is bonds will sell at a premium if the coupon rate is higher than the rate of return that the investors demand. And with respect to interest rate risk, we saw that the longer maturity bonds have greater interest rate risk than do the shorter maturity bonds, because the longer maturity bonds are subject to the higher discount rate for more periods, and thus they will lose a greater percentage of their value when interest rates go up. Now let's briefly address the issue of how bond prices are quoted in the financial press. What we've been doing so far is pricing bonds always on or immediately after a coupon payment has been made, because we've always had some nice, neat integer number of periods. We've always had 10 years to maturity, or 10 semi-annual periods, or 6 semi-annual periods until the bond matured. We've never talked about the price of a bond in between the coupon payment dates. And certainly a bond is more likely to change hands between coupon dates than it is on one of the 2 days during the year when it might be actually paying a coupon. So basically the approach we've been taking is what's called the clean price. We assumed that a bond was trading hands on a coupon payment date. Now, bonds are quoted as a percentage of their par value. So if I see a bond quoted as 101.5, that means 101.5% of the bond's par value. So for the typical bond with a $1,000 par value, that bond would sell for $1,015. If it is in between a coupon payment date, it will still be quoted as a percentage of par. And what we need to reflect is the fact that every day that somebody holds that bond, they're moving closer and closer to the next coupon payment date. So every day they hold that bond, they're entitled to 1 day's more interest out of that next coupon payment when it is made. So if somebody sells you a bond in between coupon payment dates, when you buy it from them, you really owe them part of that next coupon payment, because they've held the bond for a portion of the period of time between coupon payments. When we account for that accrued interest that has taken place since the last coupon payment, we call that the dirty price. We're adding on accrued interest on top of the quoted percentage of par price. So the dirty price includes that accrued interest since the last coupon payment date. In example 7.8 here, you've decided to purchase an ABC bond with a face value of $1,000 and a market quote of 105. So it's selling for 105% of its $1,000 par value. The clean price then would simply be the product of the two, 105% of $1,000 or $1,050. That's the clean price. Now in Part B, we're going to actually purchase the bond in between coupon payment dates. So you purchase the ABC bond on March the 1st of year 1. Well, this bond pays coupons on January 1 and July 1 of each year. So when you buy it on March the 1st, the person from whom you're purchasing it has held it for 2 months since the last coupon. So you're going to owe them part of the July 1 coupon you're going to receive because they've held the bond throughout January and February. Part of that next coupon is theirs. In fact, 2 months of the coupon are theirs, and the bond is paying coupons every 6 months. So since you buy the bond between the coupon dates, you're going to have to compensate them for the 2 months worth of the coupon, since you're going to get that coupon on July 1. Well, each coupon payment is with a 12% coupon rate for the year, paid semi-annually. Each coupon payment is $60. You're going to buy the bond on March 1st. You'll get the $60 coupon on July the 1st. You owe the seller 2 months out of that 6-month coupon payment, or $10 per month out of this 6-month coupon, right? $60 coupon paid every 6 months. $10 a month is the interest that's accruing between coupon payment dates. You owe the seller 2 months at $10 per month, or $20. Or 2 months out of the 6 months is 1/3 of the $60 coupon. Either way, it's $20 that you will owe them on top of the $1,050 quoted price. So the total amount you would pay would be the 105% of the par value, or $1,050, plus the $20 accrued interest for January and February. You would pay the seller a total of $1,070 to buy the bond, as well as pay them for the accrued interest. So that is the dirty price, and the clean price was 105% of par, or $1,050. Now let's wrap up Chapter 7 by talking briefly about rates of return in financial markets and roughly how those are set. Not really from a supply and demand approach, but more to a risk and return, or rate of return approach here. We've talked about a nominal rate in the past being the quoted percentage rate of return, or the APR. And a real rate is not just a quoted rate telling you the number of dollars to apply, but the real rate is the nominal rate with the inflation subtracted out, which is a measure of purchasing power. So if we think about the nominal rate being some real measure of purchasing power with no risk involved as a starting point, so the real, in other words, creating additional purchasing power, risk-free, no risk involved, measure of interest, then a lender would want to be compensated above and beyond that real risk-free rate for any risk that they are bearing, such as the fact that inflation might take place, the borrower might default, the longer the maturity, the more risk there might be, an investment might not be very liquid, so they can't get out of it quickly. So a lender is going to start with some real risk-free rate of interest, and they'll expect to be compensated or rewarded for bearing the risks that they bear. And that reward for bearing those risks are called risk premiums. Approximately, our nominal rate, the actual quoted rate that a lender will charge, is going to be approximately equal to the real rate, which is the lender's additional purchasing power they hope to achieve as a result of having made an investment or lended money, plus they expect a compensation for inflation. So the lender is going to charge you, quote you, a nominal rate that will give them additional purchasing power, as well as allow them to pay for higher prices as a result of prevailing inflation. The exact formula to get the nominal rate is taking 1 plus the real rate, so they'll grow whatever amount they invest by the real rate to increase their purchasing power, and then they'll grow that amount by the rate of inflation. That will allow them to pay the inflated prices on 100% of the money they invested, as well as the additional purchasing power they achieve. So the product of these two provides growth to the lender to provide them a real return, which is increase in purchasing power, and allow them to pay the inflated prices on 100% of what they bought before, plus the additional purchasing power the real return provides. So we set 1 plus the nominal to be the product of 1 plus real times 1 plus inflation. An example might help here. If inflation is expected to be 4% and an investor demands a 7% real return or an increase in purchasing power, then they want to be able to buy 7% more stuff and be able to pay 4% higher prices on everything they could buy before, plus the 7% more stuff that real return is supposed to provide them with. So approximately they would set the nominal rate equal to 11%. 7% increase in purchasing power and 4% higher prices would require them to charge an 11% rate on the loan. The exact formula is 1 plus the nominal equals 1 plus the 7% real return times 1 plus the 4% inflation rate. So 1 plus the nominal would be the product of those two. Take the 1 off. The nominal would be set at 11.28%. Or the exact formula is always going to be that approximation plus the product of the two rates, 0.28%. If inflation is 4% and a lender is charging a 12% rate, then how much purchasing power would the lender expect to gain from that? Well, approximately, they're going to get 12% more dollars. That's the nominal rate they're charging. Inflation is going to take away 4 percentage points and leave the lender approximately 8% better off. So the real return would be approximately 8%. Even though they're charging a 12% rate on the loan, 4% of that just goes to cover inflated prices. The exact formula, we could solve for 1 plus the real rate to be 1 plus nominal divided by 1 plus inflation. Thus, their real return would actually be a little less than the approximation of 7.69%. Now finally, let's address the one aspect there, that maturity risk premium. The general idea there being that the longer maturity, a lot of times there's more risk involved. But there are other ways to explain why we typically see a relationship between interest rates and maturity in financial markets. The graphical representation of interest rates, which is the yield on pure discount bonds, and the time to maturity, which is the length of a loan or an investment, is called the term structure of interest rates, or perhaps more commonly, it's called the yield curve. It's simply a graphical relationship between maturity and return or yield. So typically the yield curve is upward sloping, meaning that the longer term rates, longer term loans are higher than shorter term loans. And you'll observe this typically if you look at mortgage quotes in the newspaper. The 30-year mortgage rates tend to be higher than the 15-year mortgage rates. That's fairly common, that the longer term loans have a higher rate than the shorter term loan. Even on the same home at the same time, you'll pay a higher rate on a 30-year mortgage than you will on a 15-year mortgage. There are competing theories as to why this is the case. We'll just explore one as a possible explanation. It's called unbiased expectations. Typically, a lender is going to expect interest rates to rise in the future. That's not always the case, especially if you're currently in a very high interest rate environment. But typically, the outlook is that interest rates will rise in the future, if for no other reason, perhaps, that inflation is expected to persist and rates will go up as a result of that. But if a lender expects rates to go up in the future, they're going to charge you more for loans that extend farther into the future as compared to shorter term loans, because if a loan extends farther into the future, that's during the period when rates are expected to be higher because the lender is expecting rates to go up in the future. So the longer term the loan is, the farther it goes into the future, the farther it's going into the period where the rates are expected to be higher. So if we expect rates to be higher in the future, then the lender will charge you a higher rate now on a longer term loan. So think through this here. Your banker will loan you money for 15 years to purchase a home at a fixed rate of 6%. The banker expects the 15-year rate to be at 8% 15 years from now. That's at the point when you will have paid your loan off. So looking at these two 15-year rates, the one that's in effect right now is the 6% rate that your lender could loan money out at today. And they expect by the time you pay that loan off 15 years from now, they could loan it out again at the then higher rate of 8%. If they loan you money for 30 years, they'll lock in a rate today, so they will not be in a position to be able to loan it out again in 15 years. You'll still be paying the loan off, and you will have that fixed rate for the entire 30 years. So based on unbiased expectations in simplest terms, we could kind of guesstimate what the 30-year mortgage rate might be. So think about what would happen. The lender could loan money for the next 15 years at 6%, and then the 15 years after that at 8%. So if they were to loan it over the entire 30-year period, we might guess they would charge roughly a 7% rate to be the average of the 6% and the 8% rates. Now that is a rough estimate. We didn't complicate it very much, but it just illustrates the idea that if you borrowed money today over the 15-year period at 6% versus borrowing it today over the entire 30 years, you would probably pay the higher 7% rate over that 30-year period. It'd be some average of these two shorter term rates. Again, that's approximate, but it illustrates why the 30-year rate will probably exceed the 15-year mortgage rate because they expect a higher rate over the second 15-year period. For the Chapter 7 concept reviews, it's a good idea to stop the lecture, go ahead and try to fill those in, and see if you're thinking along the same lines I am, and then run the lecture as I fill these in. So think about them a little bit before you watch my solutions. The bond definitions are straight off of the bond definition page. The first one mentions an indenture, which is that legal agreement between the firm issuing the bonds and the trustee. So it tells what rights the bondholders have, and if they're violated, the trustee can sue the issuing firm on the bondholder's behalf. Euro bonds are bonds issued in a country different from the one in whose currency the bond is denominated. So a US dollar denominated bond issued somewhere outside the US is actually a euro bond, and a Japanese yen denominated bond issued outside Japan is a euro bond. The sinking fund is an account that the trustee holds, and the company makes deposits into that fund, and then the trustee will use that to call bonds that are callable or repurchase them in the open market. Sometimes bonds are issued and the company has agreed to repurchase 1/10 of them every year, so they're all bought back over 10 years. Well, a sinking fund is used to do that. We mentioned calling bonds. A call provision is a right where the issuing firm can buy a bond at a stated price, and that's more likely to happen when interest rates have fallen, because that will make those bonds a bargain, because when the rates fall, the bond's price will have risen, everything else equal, and if the issuing firm can call the bond away at a bargain price, it will do so and then issue new bonds at the now lower interest rate. So it's like refinancing your home. When interest rates fall, you want to go get new debt from the bank to pay off your existing mortgage. Well, callable bonds will get called in using the funds from lower rate bonds the firm issues, so it can afford to call in those previously outstanding bonds. An unsecured bond is called a debenture, and a debenture or unsecured bond that takes a lesser stance or is of a lower order is called a subordinated debenture. And a bond secured by real property is called a mortgage bond. So out of the three, the mortgage bond would be safest, then the debentures that are unsecured, and then after that, those subordinated debentures that have a lower standing would come third out of those three types of bonds mentioned right there. Current yield equals the coupon payments for a year, an entire year, divided by the bond's price. So a 9% coupon bond with a typical $1,000 par value will make $90 worth of coupon payments each year. If it's semi-annual, it will make two $45 payments. So it will make $90 in coupon payments per year. We divide that by the $900 price, and that gives us a 10% current yield for that bond. Current yield is one measure of return. It's the measure that comes only from the coupon payments. So it's simply the coupon payments for 1 year's time divided by the bond's price, and that is called current yield. When market rates of interest rise, then bond prices fall, everything else equal. That is called interest rate risk. Reinvestment risk, on the other hand, is the risk that when interest rates fall, the coupon payments will be invested at a lower rate of interest. So you can see those are on opposite sides of things, and they will partially offset one another because interest rate risk and reinvestment risk are related to changes in interest rates in the opposite direction. Municipal bonds, or munis, are debt obligations of state and local government entities such as the state of Missouri, the city of Springfield, Missouri State University, or Springfield's R12 school district. That allows all of those entities to borrow on a tax-free basis. So interest on munis is basically tax-free. It allows those government entities to borrow more cheaply because they can offer a lower rate on debt because the bondholders get to keep the entire return because it's not taxable to them, it's tax-free. So a potential muni investor would want to be able to compare that tax-free municipal bond yield to some taxable corporate bond yield because they would not get to keep the entire return on the corporate bond. They know it would have to be higher than the muni yield if they're of the same risk. So what taxable corporate yield would a muni bond's yield be worth? Well, that's done by calculating the pre-tax equivalent yield. So we divide the muni yield by 1 minus the investor's tax rate. Because the taxable corporate bonds yield will be multiplied by 1 minus the tax rate, we can take the muni yield and divide by 1 minus the tax rate to compare it to what a corporate bond's yield would have to be because the corporate bond is taxable. So that corporate bond yield would have to be higher in order to be as good as the tax-free muni yield. So take that muni yield and divide by 1 minus the tax rate to get that pre-tax equivalent yield, which tells us how high the taxable bonds yield would have to be as good as the muni. Zero coupon bonds always sell at a discount prior to maturity. Investors will demand a positive yield to maturity, and that certainly exceeds the zero coupon rate. And we know that bonds with a yield to maturity or required return above the coupon rate sell at a discount. Another way to think about this is if you have a zero coupon bond, the only payment you're going to get is the $1,000 at its maturity. So when you discount that at some positive rate, you're going to get a return below the $1,000 par value. A bond's price is inversely related to its yield. A bond sells for a discount when the required return exceeds the coupon rate. And we know that interest rate risk is the risk of falling bond prices when rates rise, and that is greater for longer maturity bonds. That was all spelled out within Chapter 7 in the interest rate risk example for bond X and Y, where the longer maturity bond lost more value when the rates went up, everything else equal. So in our example in the chapter, example 7.1, we dropped a vertical there at the bond's coupon rate of 10% and drew a horizontal at the bond's par value of $1,000, and we saw that it sold at a premium when the yield to maturity was below the bond's coupon rate of 10%. So when the yield to maturity was relatively low, the coupons were relatively high, the bonds sold at a premium. And when the yield that investors demanded was above the coupon rate, the only way they could get that additional return was to buy the bond at a discount. When the yield to maturity down here on the horizontal axis increases, the bond price declines, so prices and yields are inversely related. And then we saw in the chapter the bond with the longer maturity lost more value when the rates went up compared to the shorter maturity bond. The standard par value for corporate bonds is $1,000. Prices are then quoted as a percentage of the par value. So, for example, a bond with a quote of 97.25 would sell for 97.25% of its $1,000 par value, or $972.50. The actual price you'll pay could differ a little bit from that because you might buy it between coupon payment dates and you would owe the seller some accrued interest because they're entitled to interest for the period they've owned the bond since that last coupon payment was made. So we call this price, like it's quoted, the clean price, and the dirty price includes any accrued interest. So, for example, a 6% coupon bond is going to pay $60 per year in coupon payments, right? The coupon rate times the $1,000 par value, $60 per year. That's $5 per month. It might pay $30 semi-annually or $60 at the end of the year, but either way it's paying a total of $5 in interest per month. So if the purchaser buys the bond between coupon payment dates, they would owe the seller $5 per month since that last coupon date. So if they buy it 4 months after the last coupon payment, they owe $20 in accrued interest, and that would actually be calculated on a daily basis, but you get the idea there with the monthly $5 of accrued interest, how that would work. Nominal rates indicate the percentage increase in the number of dollars over a period, while the real rate measures the change in purchasing power. You can approximate that real return by taking the nominal rate, the additional dollars you're going to gain percentage-wise, and subtracting out inflation, because inflation hurts your purchasing power. So nominal is how many more dollars you're going to get percentage-wise. Take the inflation off, and that tells you the change in your purchasing power, which is the real rate. In Chapter 7, we learned to price bonds by simply applying the time value of money principles from Chapters 5 and 6. Coupon bonds are a package of cash flows. They are a lump sum payment at maturity, called the bond's par value, typically $1,000. And they are an ordinary annuity of coupon payments that are those periodic interest payments received by the bondholder throughout the bond's life, up to and including the final coupon payment paid at maturity. We learned that bond prices and yields are inversely related. If you can buy a bond for a lower price, your yield will be higher, everything else equal. And if you have to and are willing to buy a bond at a higher price, you'll be accepting a lower yield, everything else equal. That is simply because present values and discount rates are inversely related. So if you discount the bond's cash flows at a higher rate, the bond's price will be lower. If you discount at a lower rate, the bond's price will be higher. We also learned that bonds sometimes sell at premiums or prices above par, and sometimes you're able to buy a bond at a discount or price below par, which is determined by how the bond's coupon rate compares to its yield. The inverse relationship between bond prices and yields and the fact that bonds can sell at discounts or premiums was illustrated graphically in the chapter, and that is a very important relationship and one of the important bond relationships that's spelled out in the chapter. We also learned about different bond risks and paid special attention to interest rate risk. When interest rates go up, bond prices fall, everything else equal. The definitions in Chapter 7 are so important I asked you to review those before you even read the chapter. I would ask that you review them again now at this point and pay special attention to what a coupon rate is versus a coupon payment, and how yield to maturity is something very different from the coupon rate. Study discounts and premiums. Study the risks of bond investments as well. Please study those definitions. They're very important, and it will pay off, I think, very handsomely when you complete the Connect assignment and take the exam over the Chapter 7 material. Now that you've completed the Chapter 7 lecture, you should complete the practice problems in the rectangular boxes if you have not already done so. The solutions to those are found at the end of the chapter in your course notes. You should complete the supplemental homework practice problems at the end of the chapter in your course notes, and the solutions to those are found on iTunes U, where I use the document camera and discuss them as I go, or you may find the answers in the PowerPoint file posted to Blackboard. You should attempt that blank Connect assignment that we posted to Blackboard before you actually complete the online Connect assignment. Check the syllabus for the chapters covered on the Connect assignment and the due date. And once you've completed that Connect assignment, then please come to class. We will go over the solutions to that Connect assignment. You should bring the printed out version of that blank Connect assignment, because that's the one that we will discuss in class. And if you want us to look at your individual Connect assignment, you need to print it off or bring your laptop so that we may look at it with you during the question and answer period of the class. We would be happy to look at it and answer any questions you have if you'll bring your individual assignment with you. Begin preparing early for the exam, compiling your formula sheet as you go. Do that chapter by chapter. Don't wait until the end to do that all at once, but do it as you go. And remember, we repost the Connect assignments for additional practice, so you may work those as many times as you like as you prepare for the exam. The numbers tend to be different every time you work it, so you can get additional unlimited practice using Connect.